Hi, this is Chris Simon,
Tracy Royce,
Luke Rodvold,
and this is the Red Room. Tracy, Luke, and I jump on every week to talk about real estate, acquisition,
a lot of fix and flip,
and design,
dispositions,
Airbnbs,
financial independence, retire early.
We always have a new guest every single week.
We're going to have a lot of fun, all right?
So if you're interested in any or all of those, make sure to join us on the Red Room podcast.
And subscribe to the Red Room.
Share it with your friends or join us on the Phoenix RIA Facebook. And voila, we are live here on the Red Room for, I don't even know the episode. I think we're in the 120s now. I'm going to jump into a little bit of just some market data. Like, we just stayed in that 25,000 range for about a month now. I feel like the spring market kicked it all the way down to the low 23,000s, and then now we just got this uncertainty just kind of looming around. I don't know if anybody heard, but there might be a little conflict going across the world. But we were kicking off a great spring, and now I just feel like I don't think it's died. I just think it's just slow. So we've stayed at that 25,000 units now for about a month since this all started. Like, it's not going down, it's not going up, it's just kind of staying the same. And I get into the 10-year bond, but this is what this whole conversation is about. So we'll just jump in the conversation. We got Rebecca and John with CMG Mortgage. They're part of the Phoenix RIA. They are at all of our events throughout the year. But yeah, we're just talking about what's going on in the mortgage world. Like, it's a little strange out there. We're seeing some stuff that I'll just kind of put my 2 cents in. Like, we're seeing some stuff that is a little different. Normally when a conflict starts, people run from stocks, they're scared, and they go to bonds, which generally pushes bonds lower. But right. That didn't happen this time. It literally stayed the same. And actually, so instead of getting pushed lower and then having some economic data about 92,000 jobs not being created like they had said, normally would push it lower again, and neither one of those two things happened. So what do you got for us?
Yeah.
Why is that?
Well, it's interesting. I think that we've got two forces, right? We've got, like, to Chris's point, normally there'd be a flight to safety, you'd be seeing money going into bonds and everything. But then you've got this war that just came up. And so you've got this inflationary pressure with what's going on with the price of oil, which went from, before this started, I think it was at 56 a barrel, and now we're over 100, right? And so we've got a lot of inflationary items that are out there that people, I think, are very fearful of. They're looking and they're talking about recessions again. And again, to your point, the labor market is weak, that we did not create 92,000 jobs. So we've got some forces here that are fighting against each other, and the market just in this really weird place. And, to your point, Chris, like, we were off to a really good early spring here. I mean, January, it's like everybody woke up after New Year's and the horse was out the gate and everybody was running strong, and we're getting in contracts and lots of activity, and things headed in the right direction because we've been below 6.25% interest for the entire year until we got to this point, with this Iranian conflict and everything. And so things were going really well, really strong. And then it was kind of like, okay, wait a second, pull back. The horses are like, what do I do? What do I do? And now we've got this whole Iran situation, which in spite of it, what I find interesting is when you look at all the national data and everything, purchase applications are still strong, although we saw a little bit of a pullback last week for the first time. We still have pending sales are strong. And, what you said about the 25,000 units of inventory, they're coming, people are absorbing them, then we're putting some more on the market. We're still getting strong, contract and purchase demand. But yeah, the markets are just in this really weird place. And this is like a super critical week for us, right? Because right now, if we don't start to turn this around, it's going to be headed in a direction that none of us want to go in, right?
Yeah. Yeah. I mean, go ahead.
Yeah, we talked about this just before we got on the show a little bit. Like, if you mentioned that rates were ticking around the 6.5 mark, but we all know that if consumers see a 7, it's over, right? I mean, they see a 7. Not to say it's over. It's just going to be like it's going to be the people that have to move, not necessarily are looking for a change, right?
Yeah.
Well,
Yeah.
I mean, this has happened pretty quick. I looked at our call. I mean, on February 23rd, that's when we officially had the announcement. Everybody's posting on their Instagram that rates are now 5.99. They're formerly below 6%. And here we are a month later. When you look at that same metric, we're at 6.5 as of today. So this has happened really quickly. So the data of like positive existing home sales and mortgage applications, that's kind of a lagging figure, right? And this has happened so fast. So it's going to be interesting to see the next couple weeks if these rates do stay elevated or continue to move in an upward trending, manner, if we still see that positive, mortgage application, existing home sales happen. Because I think that will slow if it continues to stay and have rising pressure.
Yeah, no, absolutely. I mean, we've been at like the highest is like 6.53, right around there. And the data continually shows that once we get to like 6.64%, then that is like the tipping point where it gets really dangerous. And then, like you said, Chris, it goes above 6.64, like all bets are off. Then people start to get really nervous. And unless you have a reason to relocate for a job, or your kids are going to a different school, or like, hello, we deal with a wholesale market, right? And unless you have a reason to sell your distressed property, which we're fortunate that we see, unfortunately, people have that need every day, right? But I mean, we're at this tipping point that this week is critical to what happens next.
Well, what's interesting too is when rates were hovering around that 6% for a long time, which all of us, in the media and in the real estate industry thought like if they hovered around 6, that'll get people off the sidelines. And it seemed like it was less than the robustness that we were really looking for. But then again, in Phoenix, there does seem to be some resiliency around like prices too. So it seems like there's this convergence of people having a consideration about what's going to happen, but then there's not the reaction that we're expecting around like what is happening too.
Yeah.
No, absolutely.
I think that's tough too. Is we got summer coming up right now. I mean, we don't exactly have some huge window to be able to try to get things back on track. Because I mean, as we all know, once summer comes, when it hits in Arizona here, things die down anyway. So, yeah, right now.
I mean, it just turned spring technically, but yeah.
And so I mean, we truly are in spring right now. But I mean, we got a couple months before we know what's right around the corner.
No, absolutely. Well, I know, and yet we talked about this at the RIA a couple weeks ago. That what's interesting is for those houses that are priced well and that are in a good location and they're in really good condition, and Tracy, you're flipping, you're the queen of that. You know how to make a house beautiful, right? And so if you have a beautiful house in a good location, you're having multiple offers. And what's interesting is we've seen the seller concessions completely disappear. Whereas we were at a high of 55% of all sellers last year were paying concessions. There was not one purchase that John and I did last year, including some for investors, surprisingly enough, that didn't have concessions on it. And so, that market, for that to like pull back, that shows what the demand is. And so, for those people who have a bona fide reason, or if that perfect property that they've been waiting for comes up in that great neighborhood, they're going to snatch it. So I think we still have that strong demand for that and will continue to. But certainly, when people see these rates going up, people are so rate sensitive that they just like to Tracy's point when you said, we thought the spring season would kind of just hit off and everyone's like, oh my gosh, we're below 6%. And to John's point, if we were there like a month ago, which it seems like it's been 2 or 3 months since that, because so much has happened in such a short period of time. But
right.
Yeah, it's an interesting market for sure.
Mm-hmm.
Yeah.
How do you see?
Go ahead,
Chris.
Tracy.
How do you see investors adjusting to this, if at all? Are they putting larger down payments? Are they asking for concessions? Like, do you see a difference in how investors are adjusting or premeditating their purchases versus what buyers are doing?
Well, and you know that we work largely with the investor market and with wholesalers, and we work with, Rahima and Jamil. And I'll say that on the acquisition side, and Chris knows this because he's involved in a lot of our projects, is that from the acquisition side, we're able to get lower prices for those wholesale properties because, the demand on the retail side, again, is kind of pulling back and kind of just right there, right? On the wholesale side, the opportunities just keep getting deeper and deeper. So again, when you have those people in a distressed market that need to sell, they have a reason to get out of that property. Maybe last month we looked at a property and said, hey, you know what? You're at 160. You know what? Call us when you're at 140. And then like 2 weeks later, they call and say, hey, we're at 140 now. And you're like, hey, listen, you know what? We want it at 130 now. Okay. So what's interesting is that if you're aggressive in the investor space on the wholesale side, this right now, unfortunately, is working to the investor's advantage because they see the rates have gone up a little bit more and they're like, hey, you know what? On the retail side, who wants this?
Mm-hmm.
Yeah, so
Tracy,
I think it's going to be interesting just going like we're at the last week of March. We really have like April and May are generally pretty gangbusters. But if it doesn't turn around in like the next 60 days, and to Luke's, I think we still get a decent June. People aren't like completely headed off, but they obviously head off to do their vacations and all that stuff. And then July, and then obviously as soon as the kids go back to school, call it mid-August. It is just like every real estate investor thinks it's time to go for another vacation, right? So not that they just didn't have two, but they're going on another one. And
says the guy who just got back from Panama.
But
we're just jealous. We're just jealous.
This could really like the gangbuster years were over 100,000 units in a year, and we've had some like low 90s and then high 80s. But like, if we stifle this spring, like we could have another year of where, and we keep talking about the end of 22, 23, 24, 25. It's like we're just trying to crawl through the mud right now.
Yeah.
And we could literally just have another one of those years.
Yeah. Well, no, and to your point, Chris, I'm looking at what the national numbers were, and just last week we had like 71,230 pending sales, and to your point, like we want to see what 80 to 100, somewhere right around there, and only for a couple of weeks last year did we even touch that 80,000 unit number, last year. And so we're like, okay, this is great. We're getting, in a better place. And hopefully this will, we're heading in the right direction and everything. But, the big thing too is, consumer sentiment is not good. Yeah. And if we think about, let's think about as we were, going into this year, everybody's talking about, oh my goodness, the second half is going to be, this gangbusters are talking about, Powell leaving office and Warsh going in and having a change at the Fed, and with Trump wanting to have the interest rates lower, and what are we going to do for that? And in the mortgage industry, what's interesting is they've been hiring a lot. Title companies have been hiring a lot in anticipation of this really strong third and fourth quarter. And it's interesting. We had I was following Housing Wire, as I do every day, and someone in the title business actually asked Housing Wire, and Logan Monchami asked him, what do I do right now with where the rates are and where this Iran situation is? I'm looking to hire people. What do I do? Do I hire people? Right. And so, in our industry, we've been ramping up for this. And so if this, whole situation with Iran doesn't turn around, and, Thursday, they're supposed to be having some sort of talk. We hope it's a real talk, right, Chris? We're talking about that,
yeah, not a fake talk,
as we were on to the podcast and everything. And we hope it's real, because if we can get something to scale back, to like Luke's point and everything, then hopefully we'll be able to see a stronger May and a stronger June. I mean, just looking at what you said about this turning around so quickly in a negative way in a month, we can only hope that we can turn it around in a positive way, the next month, and then go strongly, because, we were looking at 2 to 3 rate cuts perhaps for the rest of the year. And, aside from the optimistic Michelle Bowman, who came on this weekend and talked about how she still thinks that we may have 3 rate cuts, this year, where, they've been taken off the table from a lot of other economic experts saying that, hey, we may see rates go up again, to what Chris was saying before about how the markets are acting strangely just because of the recession, factors as it relates to what's going on with oil prices and everything.
Yeah.
Well, then you get to that danger. Oh, good. That you get to that dangerous stage of stagflation, right? Like you have a recession going down, but you can't lower interest rates because inflation's going up. So like that's that dangerous word that everybody tries to like forget about.
Right.
It's there's the effect too of, with the oil prices going up, how much that affects almost everything that we touch and buy, right? Oh, yeah. So from produce to a lot of things that we don't think about on a day-to-day basis outside of the gas in my car is, however much, 50% more than it was a couple weeks ago. But there's that trailing indicator of, okay, well, this happened last week and we're probably going to see the effects of it for another 2-3 weeks, maybe, who knows? So even if this does get resolved, that could bleed into next season, like you guys are talking about. So that's kind of the question in my mind, is even if things end tomorrow with inflationary prices on a lot of things, will that calm down, and will buyer sentiment return after that too?
Right.
For sure.
Yeah, to be interesting, guys. We're talking about like how much the gas prices go up at the pump. I got to frame a house in like 90 days. It's like 76.
Yeah.
You know what lumber prices are going to do?
Yeah.
Oh yeah.
Yeah, it affects everything. I mean, you think everything has to be transported, and all the costs involved. Yep.
Oh, no question about it. You go to Home Depot and you're going to see the changes. There's no question.
Oh, yeah.
In every single aspect. And trust me, your contractors are going to know too, and they're going to let you know.
Well, and the question behind that too is, okay, if this is a flash in the pan and prices stay about the same, okay, great. A couple, some prices have had to raise, and the gas prices have had to raise immediately. But typically speaking, once prices go up, they're sticky, or they're very, very slow to come down. So at what point do consumers just say, I just simply can't afford to keep doing what I'm doing, and I have to cut even more? I'm not out house shopping. I'm not out buying furniture. I'm certainly not renovating, so that's sort of I don't want to be overly pessimistic about what this could turn into, but it's not unreal to consider, I think.
For sure.
Yeah. I mean, you got to think about midterms too, though. Midterms change things too, because obviously you have to have it looking a specific way when the elections are coming. And if going on, think
Luke,
about
you cut out.
Yeah, Luke got a call.
Out.
I did. I got a phone call. I declined it. We're good. But no, I was saying if you've got an election coming up and everything seems to be doom and gloom, you better believe you're going to see some changes coming, because you kind of have to, because you can't have midterms with it a specific way, and if it's very negative, if you're trying to get reelected for things.
Yeah.
Yeah, it's not going to look too good for you.
Correct.
No, absolutely.
So let's hear about, let's get out of the doom and gloom. What kind of new products? Like I mentioned at the RIA is there really a 40-year interest only? I turned it on like some news. Like, is there really a 40-year interest only DSCR loan?
Yeah, there is.
And full PI also on 40-year. So it doesn't have to be interest only.
Yeah.
Wow.
Yeah. So it is there. We've done a couple of them. The rate is usually a little bit higher than the 30-year option, not tremendously, like maybe an eighth or a quarter. So, I mean, it does save you some versus the 30, but with that, slight delta of a higher rate, like it's maybe not as much as one would think.
Quarter point or something?
Yeah, like an eighth to a quarter higher than the 30-year option. But yeah, we have it as interest only and PI.
Yeah.
Wow.
But what's interesting though, and I mean, this is kind of, I don't know, this makes me feel good, is that, and obviously a lot of us are conservative and a little old school here, but when we talk to people about that 40-year product, because we're not personally fans of that product, we wouldn't do that ourselves. People say, you know what, I think I just want the 30-year principal and interest payment. They just, it sounds sexy, it sounds good. And I think that when people just, look at the fundamentals, they're like, you know what, I really like that 30-year principal and interest. So it sounds good. But
yeah, I would say it just depends on the investor.
Yeah.
We were talking with a gentleman who's a large investor down in Tucson who has like 320 homes down in Tucson. And he was picking up like 90 at the end of 25 and beginning of 26. And he liked the 40-year option just because he was going to hold on to these. And it wasn't so much a cash flow play for him. He was taking on investor money, but if he could at least, keep his cash flow position a little bit better, then he liked it. But yeah, I mean, I would say more mom and pop.
Yeah.
They generally are sticking with the 30. But yeah, I mean, we've seen a lot in the non-QM space over the last probably 2-3 years. Like maybe 22, 23, maybe 22 that Fannie Freddie came out, or maybe even earlier, like 2020. Earlier. It was like 2020. So it's about 6 years ago at this point that Fannie Freddie came out and started making investment property loans more expensive, which was their way of saying they didn't want to do them anymore. And so that could be a big opportunity in the non-QM space. In the last 2-3 years, the largest growing sector in the mortgage business is non-QM.
Wow.
And that's in large part because your large, GSEs, Fannie Freddie don't want to do these types of loans anymore. Because what's funny is we know DSCR loans have been around forever. But if you think about it, in the last like 5 years, that seems to be like the hot term for everybody. Like, oh, can you do DSCR? Yeah. DSCR? I'm like, we've been doing this for 20 years. But it's just because, if you compare a full doc Fannie loan to a DSCR loan, I mean, your pricing is not really any better on the full doc Fannie because of what they've done. So we've seen more creative non-QM stuff come out over the last 2 years.
Yeah.
I mean, I'll be super honest. The last 15-20 loans I did were all non-QM. They were all DSCR. And I mean, the reason being is they're so much easier. You don't have to have. I think the reason, I mean, you guys can tell me what your opinion is on it. I'll give you my opinion. My opinion is that it's been a very, very down 3 years in real estate in general. Between real estate and mortgages, whatever, that kind of our industry, right? And so when it's been down, when you're going Fannie Freddie and you're going to give them your W-2s, you go to give your 1099s, it might not look fantastic. But then you go to do a DSCR loan and they're going to say, okay, well, we're going to view this as a business. And they're going to say, how much money is it bringing in? You can make that work. You can pencil those numbers much easier without having to give your 1099 or, your whatever, showing, oh, I didn't have a very good last couple of years, but you can still buy a house because they're going to view it as that business. And so that's why I've been doing them. I've been doing them because it's just so much easier. And then again, once you get all your loans or once you get all your paperwork and everything in place, it's a pretty replicatable, system of how you go about it. I mean, I can usually get one in about 30 to 45 days. So I mean, I've noticed they take a little bit longer than a Fannie Freddie, than a standard one, but there's so much less paperwork. It's insane.
Yeah.
Right.
Oh yeah. Big time. I mean, there's DSCR. I mean, bank statement. I mean, we do 1099 only. We do P&L loans. CPA sign off on your P&L. We can do that. We can link like multiple of these types of things together. So we'll do like asset depletion paired with 1099 only, or we've even done asset depletion paired with DSCR, which is pretty wild. So to like explain that, say your payment's $2,000 and the project, maybe this is a purchase, so we don't have a lease agreement. So the 1007, which the appraiser does, comes in at $1,800. So it's $200 below the $2,000 mortgage payment. So now your DSCR is going to be below 1. It's going to change your terms. Some of these investors now will say, well, hey, look, you've got $50,000 sitting in a checking account. We'll just divide that $50,000 over 60 months. Hey, that just created $400. Cool, 422 DSCRs above.
Really?
We'll do it.
Right.
Yeah.
That's
so
funny.
yeah, I mean, we have, non-QM lenders who will get creative in that way too. And I think the important thing to mention, because naturally when we start talking about this, certain people who have Vietnam flashbacks of the Great Recession, they're like, that sounds terrible. Like, we're going to have all these foreclosures happen again. Like, this isn't good. I think what people forget is, these loans, these non-QM loans generally require a pretty good equity position or down payment.
Yeah, absolutely.
At least 10, 20, 30% equity in these properties. You generally have higher credit scores. You generally have reserves. With asset depletion, the whole purpose of that is you have money sitting around that's extra outside of the transaction. So, these are still safe in terms of high credit score borrowers with reserves, borrowers with equity positions. It's not zero down, zero doc.
Yeah.
Bad credit.
The standard has definitely still been 25% down. At least all of them that I've done, they're still at 75. I've had some that have been, up to 80. But I mean, I've tried to get more than 80, and it's pretty tough to get more than 80.
Yeah.
So I mean, it's like exactly what you just said, John. I mean, you're still getting 20% down. I mean, the market has to really, really shift quite a bit to be able to lose a 20% equity piece, that quickly when the market already hasn't been fantastic. So
it really mitigates risk. And then John's excited because he announced this at the RIA. Tell us about our bank statement all-in-one first position HELOC program.
Yeah, well, like we have our all-in-one loan, which you've probably heard us talk about before, which is the first position equity line of credit that comes with a checking account. The two interact with one another. So that traditionally has been a full doc loan for us, which has killed certain deals when you have self-employed borrowers or real estate investors with 20 houses and they're doing the tax savvy thing and writing it all off. But now we've rolled that out as a bank statement loan as well. And we're getting ready to release at the end of the year. We just got confirmation this week that by the end of the year, we'll do that as a DSCR loan too.
Yeah.
Which would be really
cool.
So there's just a lot that have come out in that non-QM space to really help kind of fill the void.
Well, yeah. And then let me mention this, because I think this is like crazy. When Luke's talking about like 20% down, we talk about mitigating risk. So if we have somebody who can't qualify on paper, because we've been talking about investor loans with a DSCR and, all this, right? But if we have someone who wants to live in a house and they can't qualify on paper, we can do like with 20% down, what we call like a no ratio loan, right?
I think it's more. I think it's like 30% down.
30? Okay.
Yeah. So we can do it where like it's a no doc loan, but it's 30% down.
Okay.
Right.
Oh, wow.
Which is pretty
probably just an appraisal or something.
Yeah. Yeah, we just wanted to see the appraisal value. You put 30% down, and we don't verify it. We still look at credit,
right?
So we'll still look at credit, but like if your DTI or anything doesn't work, it's like all right.
Yeah, it's credit and asset driven.
Yeah.
I mean, part of what I'm hearing too is, despite all the unpredictability in the real estate market, we as investors adapt, and especially with acquiring homes, times like this and uncertainty actually lend to better opportunities. And it sounds like you guys have really been able to take advantage, or your clients have been able to take advantage of these products. So, in as much as it's not ideal to be navigating all of this, this is what we do as investors, right? We understand, we adapt, and we grow.
Right. No, absolutely. And I mean, now's the time, like I said, to take advantage of it, because, when you're looking at the acquisition on the wholesale side, that's some really deep deals, and just kind of be patient and wait and just say, hey, you know what? I want to pay $20,000 less for this, and then rehab it. Then you look at the ARV, and we're really good about, comping out those ARVs, and then get a DSCR loan and get some nice positive cash flow. It's awesome.
Well, that, and with uncertainty creates wholesale opportunities. So if you got a wholesale opportunity, and I know Luke's been doing a little bit of this, where you get it so low and you got a good DSCR exit because the rent's good, like you can keep it and you don't have to fix and flip it. You don't have to wholesale it. You can just keep it because you got it low enough. So.
Yeah, no, absolutely. No, and I think we talked about this at the RIA like a couple of months ago, but we had one of our RIA investors refer us to a young man who purchased 11 properties. Yeah, he purchased 11 properties in Sun City. And originally I was like, oh my gosh, what rose Scooby-Doo? What is this guy doing buying in Sun City, right? Like, oh my goodness. And he was buying them like 60, 65 cents on the dollar. And so then when we were DSCRing him out at 75 cents, then he was getting money back, and he was essentially buying these properties for free. And so the guy's got like a couple $1 million of equity sitting in his property and didn't pay anything. Hey, Luke, how are you?
Hey.
This is totally distracting.
You know, this was just easier. I'm just going to come over here.
Luke,
I know. What the heck? Look at you guys.
What's great is he just had to drop off a check at the office.
Yeah, right.
Oh,
Exactly.
is that what you were smiling so big?
Exactly what we're talking about. And if I'm gonna try to keep some of these houses, I got to get this guy paid first. All right.
There you go.
Yeah, we got to pay Chris back when Chris lends us.
Yeah.
It kind of works really well if we pay him back, and then Chris goes, "Okay, you paid me back. I'm going to give you some more money." That's how it works, right?
Yeah.
And then Chris is really happy. And then when we pay him back money, you notice how he always gets on a boat and he goes someplace.
Yeah.
Right?
Right.
Like, Luke, you're going to give him that check, and where are you going next, Chris? Right?
Yeah, Columbia.
Yeah.
No joke.
I feel like the name of the boat should be interest only.
There you go.
Exactly. I don't know if you know this, Chris, but we have a flip we're doing together.
Yep.
And we just listed it on Sunday.
Yesterday. Oh, I thought it was yesterday.
Yeah, listed it Sunday, and we just got pretty much a full price offer with a little bit of concessions yesterday. So.
There we go.
Very cool.
There you go.
What a cool announcement for the podcast. Yeah.
Yeah.
There we
What
go.
curious? What's the price point on that?
So we listed it at $550.
Okay.
Okay. So,
Yeah, so it's in Prescott. So listed it at $550.
Okay.
It's gonna be good. I think we're all in $430. So
There you go.
That's good. Okay, so we're like no pun intended, but hello. Are things heating up a little bit more in Prescott again?
so it's interesting. So we've listed about 5 this year in Prescott, and they all went pretty quickly. But at the same time, we kind of do a little bit more wild design, and so a lot of the people that are buying our stuff in Prescott, it's for Airbnbs.
Yeah.
Right.
Okay.
Right.
Makes sense.
So it's a bulk purchase.
Well, yeah, but you have such a great niche market, and you do such beautiful work up there, you and your wife, so we got to give the wife credit, right? What's going
Yeah.
on, right?
Let's be honest. Who's doing that?
Yeah.
Our houses aren't for everybody. I can tell you that. But they're fine.
Yeah. Well, good. Well, congratulations. That's awesome.
Heck yeah.
Yeah.
Well, thanks.
And then-
We appreciate you guys jumping on like always, and we appreciate your support at the RIA as well, which is always the third Tuesday. We got Rahima coming the third Tuesday of April. We're in the big room. We're gonna have like 150, 200 people. So if you are in Phoenix and you're watching this, make sure you head to the Phoenix RIA, third Tuesday of the month. And thanks again for jumping on, guys.
Yeah. Our big expo.
Cool.
Yes.
It's great to see everyone.
We'll
Me
see you
too.
guys.
See ya.
Okay. Take care.
Hey, thanks for watching that episode. And this is the start of your real estate journey. There's over 100 episodes and a bunch of playlists. And please hit subscribe before you move on to the next video.